All right, let's jump right in. Today, we are tackling one of the most powerful, maybe the most powerful tool in business, the balance sheet. Seriously, you can think of it like a financial X-ray. It lets you see in an instant if a company is strong and healthy or if it's in big trouble.
So, what exactly is a balance sheet? Well, here's the best way I've ever heard it explained. You know how an income statement is kind of like a movie of a company's whole year? It shows all the action, the sales, the costs, the profits, all playing out over time, right? Well, the balance sheet, that's a photograph. It's just one single snapshot, freezing a specific moment to show you exactly where the company stands financially on that one particular day.
Okay, so here's our game plan. We're going to start with the one golden rule you absolutely need to know. Then, we'll look at why investors are, frankly, obsessed with this thing. After that, we'll break down the three key ingredients: assets, liabilities, and equity. And then, we'll put it all together to see how it works in the real world.
All right, let's start with that snapshot idea. The whole concept of a balance sheet is built on one simple, totally unbreakable rule. If you get this one thing, I promise everything else just clicks into place.
And here it is. This is the golden rule of accounting. Assets equals liabilities plus equity. That's it. It's that simple. Everything a company owns has to equal everything it owes to others plus the owner's own stake. This formula must balance every single time. It's not a suggestion. It's like the law of financial gravity.
Now, before we get into the nitty-gritty of what all those terms mean, let's talk about why this is so important. When an investor pulls up a balance sheet, they aren't just looking at random numbers. Nope. They're trying to answer three really big, really crucial questions about the business.
First, what does this company actually own? What are its resources? Are they valuable? Second, how much debt is it carrying? Is it using debt smartly to grow, or is it maybe a little too leveraged, a little too risky? And third, how much skin do the owners have in the game? A good balance sheet lays all of this out clear as day.
Okay, so let's start pulling apart that golden rule, beginning with the left side of the equation, assets. Put simply, this is all the stuff the company owns.
So here's the key thing to remember. An asset is basically any resource the company controls that has some kind of future economic value. It's the good stuff, the valuable things that help the company operate and, make money. And assets pretty much get split into two main camps. On one side, you've got your current assets. These are things that can be converted into cash relatively quickly, usually within a year. And on the other side, you have your fixed assets. These are the big long-term resources that really form the backbone of the business.
So what do we talk about here? Well, current assets would be things like cash itself, inventory sitting in a warehouse, and something called accounts receivable, which is just a fancy way of saying money that customers owe you. Fixed assets are the big-ticket items: land, buildings, equipment, that kind of thing. But there's a really important note here about something called depreciation. See that delivery truck a company owns? It loses value every single year. But land? Land is often the big exception. It usually holds its value or even goes up over time.
All right, so that covers what a company owns. Now let's flip over to the other side of that equation and start with liabilities. This is all about what your company owes to other people.
Yeah, to put it simply, liabilities are the company's debts. It's the money you owe your suppliers. It's the loans you took out from the bank, any financial obligation you have to an outside party.
And just like with assets, liabilities get split up based on time. You've got current liabilities, which are the short-term debts you have to pay off within a year. Think of a monthly bill from a supplier. Investors watch this number very closely because if these short-term debts are way bigger than the company's short-term assets, well, that could be a red flag. It might mean they'll have trouble paying their bills. Then you have long-term liabilities. These are debts that are due more than a year from now, like, say, a 10-year loan you took out to build a new factory.
And that brings us to the final, and maybe the most interesting piece of the puzzle: equity. So if assets are what you own and liabilities are what you owe, equity is what's truly left for you, the owner. Okay, here's the absolute best way to think about equity. I want you to imagine the company sells off everything it owns, all of its assets, and turns it all into a big pile of cash. Then it uses that cash to pay off every single one of its debts. The money that's left over at the very end, that is equity. It is the real bottom line value of the owner's stake in the business. So where does this equity even come from? Well, it mainly comes from two places. First, you have stock purchases. That's the cash investors put in to literally buy a piece of the company. The second source is something called retained earnings. This is super important. It's the profit the company has made over the years that it decides to reinvest back into itself to grow instead of just paying it all out to the owners.
All right, enough theory. We've gone over the golden rule,
Assets equals liabilities plus equity. So now, let's put it all together. Let's run through a quick practical example to see how this thing actually works in the wild. Okay, let's try this out. Picture a small company. We know what it owns, some cash and some inventory, and we know what it owes. It's got a single debt, maybe a loan. So based just on that, can we figure out its total equity? Let's see. Okay, first things first, let's add up the assets. We just take what the company owns, which is that $50,000 in cash, and add the $20,000 in inventory. Boom, that gives us $70,000 in total assets.
Now for the fun part. We just have to shuffle our golden rule around a little bit. If assets equals liabilities plus equity, then a little bit of simple algebra tells us that equity has to be assets minus liabilities. So we take our $70,000 asset total and we subtract the $30,000 in liabilities to get our answer.
And there it is. The company's total equity, the owner's real share, is $40,000. That's the true value of their stake once all the debts are paid off. See how that financial snapshot starts to become crystal clear? So there you have it. We've just learned how to read this incredibly powerful financial photograph. We can now look at a business and see what it owns, what it owes, and what's really left over for the people who built it. So the only question left for you is, now that you can read the snapshot, if you looked at your own business or a company you really admire, what story would its balance sheet tell?
American business and management. It's a big one. So, this is the big question we're going to tackle throughout the entire module. We're really going to explore what makes business in America tick, right now. So here's our game plan. We've got 3 main steps to guide us through. First things first, to get where we are now, we've got to go back. We'll start with industrialization. This was a total game changer for how business was done. And then we'll see how globalization basically blew the doors open to the entire world. Okay, so let's jump to today and see what that history actually created. And of course, we have to talk about tech. Its impact has been absolutely massive. We'll get into the nitty-gritty of the opportunities and, the challenges out there. So what's the point of all this? Well, it's all about getting to your end goal. See, everything you're going to learn here helps you build one really, really important skill. And that skill, it's understanding these core ideas: capitalism, innovation, and entrepreneurship. This module will give you the tools to tackle what's coming next for American business.